Welcome to CMO Confidential, the podcast that takes you inside the drama, decisions, and choices that go with being the head of marketing. Hosted by five-time CMO Mike Linton.
Welcome, marketers, advertisers, and those who love them, the Chief Marketing Officer Confidential. CMO Confidential is a program that takes you inside the drama, the decisions, and the politics that go with being the head of marketing at any company in what is one of the most scrutinized jobs in the executive suite. I'm Mike Linton, the former Chief Marketing Officer of Best Buy, eBay, Farmers Insurance, and Ancestry.com. Here today with my guest, Dr. Dan McCarthy. Today's topic, the rise and fall of Peloton as seen through the eyes of CLTV. Now, Dan recently became a fully tenured professor at the University of Maryland. Go Terps, or fear the turtle, or whatever you're supposed to say. Previously, he was an assistant marketing professor at Emory University, where he created what may be the first customer lifetime value course. He also built a predictive analytics film called Zodiac, which he sold to Nike in 2018. He also founded Theta Equity Partners with his partner, Peter Fader of Wharton, who has also been on our show. Now, Dan's specialty, and I know you're going to love this, stay on the edge of your seats, is the application of statistical methodology to contemporary marketing problems. So Dan, this is Dan's second time on the show, but it represents the first time CMO Confidential has discussed a math case in detail. We're even going to do a chart here. So welcome, Dan.
Thanks for having me. I know you hear math and you say, oh my God, what am I going to be listening to? But I promise this is going to be a ton of fun.
We look at CMO Confidential. We love math. So we think, and math to me is 70% of marketing. So let's, before we dig into Peloton, why don't you give our listeners a brief recap of your first show on customer lifetime value? Refresh how it works and what you teach.
Yeah. So what is customer lifetime value? It's this number that's sitting on top of your head for every brand. And what it represents is how much profit the company is going to make from you on all the purchases that you have made in the past and will make in the future. And it gives companies a really helpful reference point to say, if I'm going to make $1,000 off of this customer, I'd be fine, paying up to, call it $350, maybe even $500 to acquire them in the first place. And so really helpful to know how profitable your customers are. And it's also very helpful for your investors to know, because that's going to be a key driver of your ability to stay profitable if you're already profitable, or to become profitable in the future if you're able to grow enough in the future if you're not profitable yet. And so we're seeing all these different stakeholders, whether it's investors, regulators, executives, obviously the head of IR, CFO, CEO. We're just seeing a whole bunch of different constituencies, but obviously it's the CMO who traditionally has been the one that manages those relationships, kind of diving in and trying to understand, what these figures are for their business. So that's what I teach. It's what I research. It's what I live. It's a really fun topic.
And it is an awesome thing. And Dan is shorthanding. He's making it sound easy, but it's not. Because you have to have a bunch of databases and then cohorts, and you have to be looking at churn rate and customer acquisition cost and everything as it moves. But it is a superb way to take what you are doing now and project it, what it's worth into the future, and to put a lot more math around a lot of marketing if you can do it. So let's
if you want.
Sorry?
Yeah, maybe just a few ways it could be kind of hard. For one. Yeah. At most B2C businesses, 40 to 80% of your customers have only bought one time.
Yeah.
So this is a big question. All right, what the heck are they going to do in the future? And they're probably not going to do a whole hell of a lot collectively. But the fact that upwards of 80% of customers are in that bucket actually means the number of purchases you get from those people can be surprisingly high. Again, it depends on the business. But there's this really hard sparse prediction problem that you need to make to really get the flow of purchases and spend right into the future. And then there's all these questions about costs. And usually when you move to costs, that's where all the marketing academics' eyes glaze over. And they say, variable costs, whatever, discount rate, whatever. Let's just use 10%. And what I found is that oftentimes you can have a good business or a bad business based on the margin, the contribution margin that you're earning.
And that makes such a massive difference in money, especially. And let's flip over to Peloton now. If you think you're a growth company and you're relentlessly pursuing growth, that margin can eat you alive if you get it wrong. And I think we're going to talk about that. But Dan, give us an overview of the Peloton story, starting with the pre-IPO and their stock price. And then you watched them over time and got all the data from them because I think they make it public. Tell us the Peloton story, give us the cliff notes of it right now so we can then go into the charts.
Yep. So so John Foley's the one who kind of led the charge as their founder and CEO for quite a while. They'd gone public a number of years ago. At the time, they basically, for those of you who aren't familiar with the brand, they sell basically higher end bikes for the most part, although they also do treadmills and now rowers. And essentially you sign up, you pay, on the order of at least a couple $1,000s for the bike. You then pay the subscription fee, which at the time of the IPO had been around $39 a month. And essentially what it attracted was this really almost cult-like following amongst its user base. And those customers would stay around for a very long time. So they tended to not churn. They would often buy more than one. And in general, even though they weren't profitable at the time, the economics of that business were actually pretty good. They continued to grow well. And then they hit...
Stock was somewhere around 70 or something, right?
Yeah, and then COVID hit. And that was kind of, you could think of that as God's gift to Peloton, because everyone wasn't going to gyms anymore. Instead, they were finding ways to try and work out at home. And so it led to this humongous surge in demand for Peloton bikes. And it led to such a surge in demand that the company was having trouble keeping up with that they didn't have enough bikes available. And so they made relatively expensive acquisitions to increase their ability to satisfy that demand. But the problem was, as we all know now, the COVID surge in demand didn't last for very long. And so they said, all right, now we've got the ability to supply everyone who wants a bike. And then that demand fell way back down. And it kind of left them with all of these excess costs. And they've been trying to try and find a way to kind of work themselves out of the situation. One of the things that they decided to do was to dramatically cut price on the bike. So they used to make a whole bunch of money on the bike, and now they actually lose money on their hardware. Thankfully, they also raised the cost of the subscription from $39 a month to $44 a month. That was, I think, in retrospect, a good decision. It doesn't seem like there was a dramatic game-changing amount of churn. Whatever increase in churn there might have been, I think, is more than offset by the increased profitability on that subscription stream. But because they had, before COVID, about 2/3 of their revenue coming from hardware, when the hardware revenue started to go into free fall, it really caused the whole business to go into a tailspin. And
a massive tailspin. Like their stock is, I don't know what it is now, but it's somewhere around 5, I think.
Yeah, it's really there's a lot of people who are talking about whether they're going to be able to remain in business. And these private equity firms are now swirling around, kicking the tires. But there's some real existential questions about what the future state of this business is going to be. And there was someone who they brought in. So John Foley, some could argue that he didn't manage the business all that well through that period of growth. He kind of got faked out a little bit. So Barry McCarthy came in, no relation to me. I kind of wish, but he's super sharp guy. He had been the CFO of, I believe, both Netflix and of Spotify. So this is a man who really knows the subscription model,
right?
And he's basically led some of the very best subscription businesses in the world. And unfortunately, he wasn't able to really figure it out. I think he wanted Peloton to become kind of like the Netflix. Yeah, he called it fitness as a service.
Right.
But kind of everyone will use the Peloton services, and obviously lowering the price kind of makes sense if that's your vision of where you see the business heading. But unfortunately, that didn't really work, and he's subsequently left.
Well, and we're going to talk about this after we go through the chart, because this is growth. This is also, in my mind, when you look back on it, growth at all costs. And, we're going to grow, and because we're good at bikes, we're going to be good at treadmills and rowing, which to me it's not an easy, not a natural transition. And we can talk about that. You get all your data from all the public reports that Peloton puts out, right? There's no inside data here, right?
Yeah. So I had started following them as you kind of alluded to back when they dropped their pre-IPO prospectus.
Yeah.
And they put some really neat data in that filing. And I think basically everyone involved with Peloton amongst investors is frustrated with me, because back at that time, there was this story that was going around about how their churn rate was imminently going to explode. And the reason they were going public was so they could kind of cash out. Yeah. Everyone gets their money, and then the stock, implodes. And they were pointing to the churn rate as being the cause why.
Yeah.
So I went into the numbers, and I found that there was no major skeleton in the closet at the time. Yes, that was kind of it was actually a big contrarian positive argument.
Right.
But yeah, I've continued to follow them. We ended up buying a bike of our own. We love it. Both my wife
I have a bike. I love it too. I even have a Peloton shirt. So yeah.
Yeah, we religiously use it. So certainly I don't have anything against the company. In fact, I really want them to succeed, if only because I want to continue riding the bike. So certainly there's no agenda there either. But yeah, I would say one of the good things about this business is that they've continued to regularly disclose their churn rate, which has allowed us to get a lot of good visibility into the different drivers of the value of customers.
Let's put that chart up and tear it apart a little bit. And for our viewers, well, if you're listening to this on audio, you obviously can't follow the chart. But for our viewers, there's a couple key components of this chart that we're going to highlight. So Dan is putting it up right now. But we're going to focus in on the strategic choices and what it did to the marketing math here. So Dan, let's take this away and show people the strategy as seen through the eyes of customer lifetime value and what it did to the financials.
Yeah, so there's really kind of three main drivers of how much customers are worth. Again, when you sign up for Peloton, typically you buy the hardware.
Yeah. They
do have something called the All Access membership where you can technically be a subscriber without the hardware, but they've really de-emphasized that. It's not something that is a strategic focus for them, and it's not really a big part of their business.
Right.
So really it's how much are they going to make on the hardware? So when they sell that bike, how much profit do they make? Yeah. How much are they going to make on the stream of subscription payments that people make? So they get the revenue from your subscription, and then they have to pay off all their variable expenses, including the instructors. Whatever they leave, that's kind of the profit that comes from subscription. And then there's the amount that the company had spent in the first place to acquire the customers. And so you kind of add all that up.
And that is customer acquisition cost for everybody. Yeah. So
yes. Yeah. So CAC stands for customer acquisition costs. That's right. So so it's really kind of simple math. The value of a customer is going to be a function of those three things. And to the company's credit, they've given us a whole bunch of information to be able to just kind of do the math on each of those three. So, very simple bike math. You can look over here. This shows basically the historical financials for the connected fitness products, which is essentially primarily the bikes.
And if you take this chart apart, though, it is you can see the massive changes in the strategy and the COVID years, right?
Mm-hmm. Yeah. So if we just kind of focus on hardware for a moment, you can see that back 2017, 2018, 2019, they were doing basically something like a 45% margin, which means they're making a hell of a lot of money on the bikes.
That is a huge margin. Look, for perspective, Most companies are not even close to this kind of margin, and they're making this on the hardware, right?
Yes, this is like more profit than Apple makes on the iPhone, you
Yeah.
know? I mean, it really is. And so if they sell a bike for about 2,200 bucks and they're keeping about 45, 44% of that as profit, then the profit on the bike is about $1,000 bucks.
Yeah.
And one of the things that they were touting, I'm just going to scroll down here. This was from their, I believe it's from their investor prospectus, but they were saying how there's this amount of money that we're spending on sales and marketing, their customer acquisition cost. This is how much profit they get back on the bike. And so if you do it out, their net customer acquisition cost is only like $5. I mean, they're basically acquiring these customers for free when you take into account the profit on the hardware. And so all of that subscription profit is basically gravy. It's icing on the cake.
Yeah.
And
it's already a great cake, and now it has icing on it in the terms of a sub model that costs you almost nothing to scale.
That's a great model,
Yeah.
I mean, so I think that was part of what was really appealing to me and to a lot of other people at the time of the IPO. The other thing that's appealing is if you're willing to shell out 2,200 bucks for the bike, you're probably willing to stay for a while. So for one, you just spent a lot of money on the bike. You don't want to churn, right? Because what are you going to do with the bike? So the margin on the subscription was also actually it was about the same as the margin on the hardware. This was at the time of the IPO, so about call it 45%. And so of that $39, Peloton was keeping about $17 as profit. And these customers were staying around for an absolutely mind-boggling amount of time. Like they were not churning. And that was something that the company was really playing up. And they deserved that. I think they deserve that, those positive words, because this is not a churn rate that you typically see for a B2C business.
So it's all good. And then you hit COVID and it still looks really good. And then what happens? We're going to go to the right side of that chart, I think.
Yes, this is our before, this is our after. And the after ain't looking so pretty. So they went from about a 45% margin on the hardware to like a -10, -20% margin.
Because they discounted the hardware, or because they added new hardware in, or they just started spending so much money on hardware? What actually happened there? That was
April 2022. They cut the price of the bike from about 2,200 bucks to about 1,400 bucks.
Yeah.
So again, this is like an $800 delta, and that's on the list price.
That's all margin too. That's all.
So they just said the price is going down. And so that's pure, if you're making 800 profit, you cut the price by 800, the profit's gone. Yeah. So that was kind of the biggest driver. There were other factors as well, but that was kind of the elephant in the room. And so again, if we just kind of take this, let's be generous, let's give them a $0 profit. Again, we can see here, they're probably losing money on the hardware, but even if we take it to zero and leave everything else the same, suddenly the return on investment has plummeted. Yeah. And the problem is, as we were kind of talking about with COVID, all these people started to not want bikes anymore. I think there was a lot of demand that was pulled forward. If they hadn't bought during COVID, they probably would have bought in the future. Yeah. So they hit this wind pocket. And I have this chart over here of their customer acquisition costs through Q4 of 2022. And you can see for many, many, many quarters, their CAC was between, $350, $500.
Fabulous CAC. And now their CAC is
$1,300.
Yeah. So 3.5 times what it was. So, but the other thing, I think, didn't the concept that they were going to do what they did on bikes and carry that over to treadmills and rowers, that's probably a little flawed concept in terms of consumers wanting to continue to shell out massive amounts of money and capital and the sub model, right? I mean, so all this money is actually going to impact churn and expenses, right?
Yeah. And so that's kind of one of the big pieces that actually only indirectly shows up here. These are all variable economics, and that's kind of an important point about what CLV is supposed to be. CLV is supposed to be, you acquire that next marginal customer, what is the incremental profit that you're going to get? And so all the overhead expenses associated with the business don't factor into these numbers at all.
Right.
But kind of what's going on in the background is Peloton has been spending a lot of money on overhead expenses. And this is not just the CEO's salary. They're spending 11% of their revenue on research and development. And the R&D is for things like a new rower, the next gen version of the treadmill, et cetera, et cetera. And as you're kind of alluding to, the reason that they were doing that is to be able to continue to show very strong revenue growth. So they have this really good, it's like the bird in the hand with the bike business. And I think if they were to really try and squeeze that for profitability, their revenue growth may not be quite as strong, but they could be dramatically more profitable. They've been trying to continue to invest in all these other types of hardware to be able to.
In my mind, they do not have a right to win in those spaces. And running is different than biking, because I can actually run in the rain and in the dark and in the snow. And I don't want to spend $4,000 on a treadmill, but biking is a little harder. And also the whole Peloton concept, doing it with the pack, the running thing is less of a consumer story in my book. So
yeah, I think it's a big open question. Yeah, I think that also beggars can't be choosers. If you're in such a difficult position right now, again, that 11% figure, that was like from the most recent quarter. And this is after all of these stories, after the big drop in their stock price. You hear about the private equity firms swirling around. It's like, you're still spending 11% of your revenue on R&D.
On rowers, which, I mean, look, rowing is a great thing, but I can't believe it's a big thing. Let's move off the chart, because I think we made this point and say, one of our earlier guests, Tom Goodwin, who's a futurist, said Peloton would have been a great value company if it had just stuck to bikes. But in its determination to become a growth company and move into all these things, it lost touch with its consumer and with its with what it was really bringing that was different to the marketplace. And it kind of thought, we're going to take over gyms and everything's going to be great. And this is at its core one of the arguments between being a value company and growth company, because growth companies get great multiples and value companies don't move like that, but they also don't get punished from a 70 to a 6 stock price. Can you talk about that? Like, just this whole growth value story?
Yeah, this also, it kind of alludes to how some people will define CLV. They'll just say it's the net present value of the revenue. And no, you can't put revenue in the bank. You put profit or cash flow in the bank. And yes, I think a lot of companies will obsess over revenue growth when in truth, what they should be caring about is some sort of profit measure. But yeah, I think that, again, Peloton for quite a long while had been a privately held VC-backed company. And, VC companies in particular, they often have a very strong incentive to post revenue growth. And,
right.
And that's
because the multiple.
Yeah, you want to grow enough to be able to raise the next round at the higher valuation. And in those VC rounds, they can become kind of like a painkiller, that yes, we're not profitable. Yes, we burn more money than before, but now we've got a new war chest. And we know that if we want to raise our next round, we need to grow beyond a certain amount to be able to show that to our investors. And so again, it leads to this kind of lack of emphasis, I think, on things like R&D expenses and whatnot, because I can show you a very low churn rate. I can show you a good profit on the bike, but so my CLV can look ostensibly quite good, but I can still be losing a whole hell of a lot of money. So I think when that's what you're used to, that's what you were born that way, you were brought up that way, that's kind of how you're wired. And so it's kind of not that surprising for companies like Peloton to continue to be like this, even after they're public, despite the fact that there are now, clear signals that this is not working so well.
But this happened a lot in a lot of B2B businesses, I think, post-COVID, when there was that great reevaluation of this growth is not worth nearly as much if it's not profitable. And you watch all these companies get revalued almost overnight. That's what happened. These guys are just part of that, right?
I think there has been a shift recently towards profitability, away from growth at all costs. So I do think that we're seeing a lot more of that now. I think some of that's healthy. I think there are some businesses that are almost skewing a little bit too much towards profitability today.
Yeah, they're not innovating at all for the future. They're just harvesting stuff.
Yeah, and I think if profit's coming in the future, that still can be very good for you. And so you don't need to discount all that to zero. But, I do think that the truth is in the middle somewhere, that you don't have to be overall profitable right this very second. Yeah. But at the same time, you want to make sure that you have a sound business.
So Dan, let's write marketers and the marketplace into the story. Because if you're sitting there in the marketing space and you're looking at CAC, you're looking at retention, the churn cohort, you're looking at the total addressable market, which red alarms should probably be going off post-COVID, where you think, are we really going to be able to sell a lot of bikes to people that are going back to gyms and going outside? If you're sitting in there in the center of this and your company is hell-bent for growth, and one of your jobs is to generate growth, but you want to tell the story that this growth is maybe not there. How do you do this? And how do you do this without being labeled a non-team player?
That's really hard. Yeah, because if you're within marketing, that marketing spend, it's going to be allocated to customer acquisition cost or some form of retention marketing. So I think your budget's going to show up on this spreadsheet. And so we'll be very attuned to things like customer acquisition cost. I think the key is to make sure that on the other side, again, they were spending $1,000 to acquire customers before. And you think about typical B2C businesses, most of them, there's not a snowball's chance in hell they'll be able to make money on customers when they're spending $1,000 to bring them in the first place. But, Peloton was able to do that, because of the hardware profit and then because of the subscription payment. I think the real key is to make sure that they're able to, first, I think it is very helpful to get some of the profit back on the hardware. I think for one, it helps defray the CAC, but for two, it's going to bring in a better quality customer. If you're bringing in a customer who never would have bought at $2,200 and is only buying because they're spending $1,400, you're bringing in a more price sensitive person,
Especially in a product like this, where you think if it's been out 7 or 8 years, by definition, you're down into the TAM that is less committed. And maybe you are that much better and maybe the world's changing, but you ought to really be thinking about the TAM. And I would suggest that the chart you had up would be a chart a marketer should be using to say, hey, I don't want to just talk about CAC. I want to talk about the TAM and the growth story and whether or not the consumer is really ready to continue purchasing at the rate we want, regardless of how well we sell and deliver to them.
Absolutely. It's kind of
or else you're going to get a plan and then you're going to get fired in a year or two that you didn't make this plan, that the math would say no one could make. Hercules couldn't make that plan.
Mm-hmm. And I would say, when you think about what TAM is supposed to represent, oftentimes it's actually the serviceable addressable market.
And that's total addressable market. If people don't know exactly. So, yeah.
Yeah. So that and the serviceable addressable market are two terms that we'll often focus a lot of attention on. And if you lower the price of your bike, the addressable market will get bigger because there's just more people who wouldn't buy at the higher price that will buy at the lower price. So that is undoubtedly potentially a good thing, but you have to weigh the benefit of the enlarged TAM against the different costs that you will incur because of that. And so there's kind of two big ones. The first is you're now trading hardware profit for TAM and you're bringing in a lower quality customer. And you just have to.
I have to say one other thing about this. I have this saying, averaging is killing us, which is if you keep averaging that TAM where you have all these really great customers in the beginning and then these less good customers coming in, and you look at the average customer, you won't see the problem until it emerges as a cohort of the most recent customers that churn a lot faster. And I think that is a super good thing to focus on.
That's why cohorts are so valuable.
Yeah, you got to look at the cohorts. You can't average all the cohorts over time because the TAM is not the same. You made a statement, valuation as a painkiller, and what it means strategically in the Peloton case and other places. And I think this goes hand in hand with another statement you made, which is everything can be good, but it comes at a price. Tell us what you mean by those two statements and use Peloton as the example.
Yes, evaluation as a painkiller, that kind of harkens back to the comments about the venture capital. And if you're able to raise big rounds and you know that if you grow, potentially grow unprofitably, but you know that if you grow, that you're going to be able to raise the next round, then, all the pain associated with potentially bad decisions, you're not going to feel because you have the capital to be able to deploy. And I think, having a high valuation is kind of a similar thing that, I have the ability to issue new equity. I've got the ability to go to the capital markets and kind of essentially bail myself out of what may have been not great capital allocation decisions. So it can be a form of painkiller in the sense that you won't actually feel the cost of that negative decision until, some point down the road. And so, to some degree, it's like you have a bad ankle, you keep running on it. If you don't feel the pain, it's not that the injury went away. It's that, you just don't feel it anymore. But as soon as you get off that painkiller, you're going to be in a world of hurt. And that's, I think, kind of where we are now, that you have this business where, the valuation has been taken to the cleaners. And now they're really feeling the pain in that ankle.
One could say it's actually a broken ankle. And also, I think this statement you made, everything can be good, but it comes at a price, would be if you are using the wrong mat and you don't feel that pain, you will make a bunch of choices that look really good, but are actually hurting that ankle even more, I think.
Mm-hmm. Yeah, right? I mean, in theory, they could drop the price of the bike to zero.
Yeah.
I mean, at some point, then the TAM will be huge. Like, we all know that they probably shouldn't do that, but it's like, where do you draw the line?
That's what makes you such a good professor.
Yes,
I think. Where do you draw the line, especially if you're trained that growth is more important than profit?
Mm-hmm. Yeah. And then how do you think about things like R&D expense and how much, overhead does your business need? I think that oftentimes some of these things, they become less important because you haven't been dinged for it. And so, why should you? And in fact, maybe you were rewarded for it. So I think, again, that's why it's really hard to blame Peloton per se. But I do think that there were a lot of tough decisions that hadn't been made because,
there was no discipline. There was a chase for growth. And then there was a belief that you'll grow your way out of this with treadmills and rowers. And so we can keep investing in this because these will light up just like the bike did. And I think that is right out of the, everything good comes at a price. So this has been, in my mind, a great case. And we always close, so I have to close now because we're almost at time. We always close with the same question. Practical advice for our audience we haven't discussed yet, and or the funniest story you can share on the air. You can pick both of those or one, but you have to pick at least one. Knock yourself out.
Practical advice for the audience that we haven't discussed yet. First, if you should be using this spreadsheet. We haven't talked about that yet, but I think we'd be more than happy to make this available to you. When you're thinking about these sorts of decisions, I think every business to some degree is thinking about the same sort of issues. You may not have, quite as big of a subscription stream. You may be thinking about repeat purchases instead of subscription revenue, but ultimately, it's going to be some version of the spreadsheet that you're going to want to be focusing on for key strategic decisions like this. Hopefully this can serve at least as some sort of a reference point for you, as you're kind of thinking through some of these decisions for your business. So we can have it available in the show notes for those who are interested.
Okay, and I think that's a great way to end the show. And I would also say that spreadsheet is very transferable to your CFO as well, which is marketer speaking finance instead of just marketing. So thank you, Dan, and thanks to everyone for listening to CMO Confidential. If you are enjoying the show, hit the like button and subscribe. Look for all of our shows on the I Hear Everything Network, Spotify, Apple, and YouTube, which include Marketing, The Battle Between Believers and Non-Believers, Parts 1, 2, and 3. The Budweiser Case, How Not to Manage a Socio-Political Issue. Is the CMO position the hardest job in business? And of course, Dan's first show, The Case for CLTV. Why is this so hard? Hey, all you marketers, stay safe out there. This is Mike Linton signing off for CMO Confidential.